The Monetary Authority of Singapore could ease monetary policy further, given the low inflation and weak growth outlook. That's what analysts say. The regulator is due to meet for the biannual policy review in April as it looks for ways to boost growth. This report by Patrick John Lim.
The central bank unexpectedly moved to slow the rise of the Singapore dollar in January as plunging oil prices eased inflation. To bolster growth, analysts are expecting the Monetary Authority of Singapore to further adjust its exchange rate policy, as the Singapore dollar nominal effective exchange rate trades near the lower end of the band set by the MAS.
We do not think that they will lower the senior slope again. However, we think that there could be a one-off downward recentering of the senior midpoint by perhaps around 2%. Now, what that means is essentially that will weaken the Sing dollar a bit, and in order to support the export competitiveness of the Singapore in 2015.
A weaker currency would help exporters whose goods become relatively cheaper in foreign markets. The central bank manages monetary policy by letting the Sing dollar trade within an undisclosed band based on its nominal effective exchange rate against a basket of currencies of its major trading partners. Recent inflation and output data was lower than expected, which suggests the economy may be slowing and facing deflationary pressure. Coupled with weak global growth, analysts say this could prompt a more expansionary stance from the central bank.
Inflation providing that platform, and looking at growth, I think it's quite clear that growth continues to be weak. Very lackluster, right? Look at what China is happening in China. It's overall still a very lackluster growth momentum. US, with the exception of the labour market reports, right, the other indicators have been more mixed as well. So the overall global growth environment remains very weak.
Whether or not the MAS opts to ease its monetary policy, the Sing dollar is still expected to face pressure from a strengthening greenback.
I expect the Sing dollar to continue to depreciate against the US dollar. We are looking at a forecast of 142 by the end of the year. Now, the reason for the weakening is coming from two sources. One is from our expectation that the US dollar will continue to strengthen as we get closer towards the US Federal Reserve lifting their interest rates. And also from mass policy by easing in April, that also provides greater room for the Sing dollar to depreciate as well.
Singapore has seen 4 straight months of decline in consumer prices, while core inflation hovers between 0.5% and 1.5%.